So have you ever wished that you could go back and do something over again? Perhaps you wished you started exercising earlier in life or spent more time with your family and loved ones. Well, with what I'm about to share with you in today's video, you'll be able to do that, but with investing. After 10 years of trial and error and some seriously painful lessons, I'm sharing the 8 investing mistakes that I wish I never make again. And make sure you stay till the last one, because my last mistake cost me thousands of dollars that you can easily avoid. If you're someone who's just about to dip their toes into investing, or you've been investing for a while now, understanding these mistakes now could mean the difference between long-term growth or years of setbacks. The first mistake is a pretty simple one, and it's not figuring out your own investing style as soon as possible. This is going to benefit you quite a lot, especially earlier on in your investing journey, by understanding the investments that are going to fit your investment style. Chances are you probably know inherently deep down inside if you're more on the conservative side or if you're on the risk-taking side. Now, if you don't know what your risk tolerance is, there are plenty of online questionnaires out there where you can answer a series of questions and it'll then tell you what your risk tolerance is likely going to be. I will link one down below, but basically after you figure out what your risk tolerance is, you want to figure out what your time horizon is as well. Are you investing for retirement, or perhaps you're investing for a shorter term goal, like saving for a house deposit, or perhaps even a wedding? It's important to understand the why of why you are investing, because it's going to guide a lot of your investment decisions down the road. Here's a spectrum of a risk to reward ratio. As you can see at the very bottom, we have a high interest savings account that's very low risk, but also very low reward. And as we move up along the x-axis, increasing the risk, we then move on to bonds, and then stocks, which are riskier, but they also do give you a more potential reward. Then we have property, which, because you'll be taking on debt, the risk is even higher, but the rewards are even greater. And then right at the top, on the top right hand corner here, we have cryptocurrency, which is super high risk, but also can be super rewarding as well. The point of this graphic is just to show you that different investments are going to suit different people, and you can tailor your own investments to suit. The risk you run if you invest into an asset class that doesn't fit your investment style is that you're more prone to making emotional and irrational decisions. The second mistake that I've been guilty of is owning too many accounts. Like many of you, I've worked multiple part-time jobs growing up, and by the time I ended up in my first full-time corporate job, I had 3 different superannuation accounts. Not once did I bother to consolidate them, and to be frank, I completely forgot I even had multiple accounts until years later. And slowly but surely, each month across each of those accounts, I would be hit with administration fee after administration fee, which slowly dwindled away at my account balance. Now, it's not like I had tens and thousands of dollars in each of these accounts, but had I taken the time to consolidate them and roll them over into one single account, it probably would have saved me hundreds, if not thousands of dollars in fees. Now, ASFA found that currently 5% of Australians hold 3 or more superannuation accounts, which equates to approximately 1.3 million people, which is probably 1 million people too high. Now, hopefully you guys don't fall into that category, but if you do, just log into the ATO website, check if you have multiple accounts, and if you do, transfer and roll them across to your main account. Similarly, in the spirit of investing and wanting to optimize your finances, you might have multiple brokerage accounts. I am guilty as charged when it comes to this, and over the years, I've used at least 6 or 7 different brokers. And whilst you might have good intentions, you have to be careful as to not overcomplicate your finances to the point that you have no idea where you stand. Bottom line is, be careful of owning too many accounts. Organize and simplify so you have a good grasp of where your money is at all times. That's why last year I decided to consolidate all of my holdings to MOOMOO. Having used multiple brokers in the past, MOOMOO ticks off all of the boxes that I look for in an Australian broker. This includes CHESS sponsorship, low brokerage fees for Australian stocks starting at just $3 per trade, and also US stocks that starts at 99 cents USD per trade, excluding other pass-through fees and FX costs. And the app also empowers you with powerful built-in researching tools in the app, which allows you to research different stocks and ETFs before you actually invest. Now, to help you find your investment style, MOOMOO also has a global community feature, which allows you to connect with investors from around the world, share your journey and ideas, as well as join live earning calls for companies like Apple that you may have an interest in. Now, MOOMOO are always innovating and coming out with new features on the app. One of the more recent ones they added, which I consistently use, is the recurring investment feature, which allows you to set up recurring investments so that you can automate your investments each month. Setting up your recurring investments is really simple. For example, you can choose an ETF that you want to invest into in the long term, and then just select the frequency and the amount that you want to invest in. This has been a game changer for me because it allows me to automate my investments each month. If you're a new customer, sign up and meet certain requirements, then you can receive up to 38 free random fractional stocks and $2,000 worth of brokerage-free cards for both Australian and US stocks for 30 days, which means your brokerage fees are basically for free for the first month. The third mistake is not updating your super to reflect your investment horizon. For the longest time, I just left my superannuation account in the default balanced option. I don't think it was until like 2 or 3 years into working full-time in corporate that I even logged into my account. Now, by default, you'll be investing in your fund's balanced investment portfolio, which is typically made up of approximately 75% growth assets like stocks and property, and then around 25% of defensive assets like bonds and cash. Now, the purpose of defensive assets is to provide stability and reduce risk in your investment portfolio. It's essentially meant to smooth out the bumps that come along with investing, but it's not focused on growing your portfolio. On the flip side, growth assets are focused on achieving capital appreciation and generating higher returns over the long term. Now, because you've probably got like 30 or 40 years until you retire and access your super, if you shift to a high growth option, it'll be slightly riskier, but with much more potential for growth. High growth portfolios are typically made up of at least 90% growth assets and 10% defensive assets. Even Australian Retirement Trust, one of the largest industry super funds in Australia, recommends a portfolio comprised of 100% high growth when you're younger than the age of 50. Morningstar actually ran the calculations to compare how much you would end up with at retirement based on 3 different portfolio allocations. The first portfolio had an asset allocation of 50-50 between growth and defensive assets. The second had a 70-30 mix, which would reflect a balanced portfolio, and the last one had a 90-10 mix, which reflects a high growth portfolio. Now, assuming you were 30 years old with $123,000 in your super account right now, and for the next 35 years your income stayed the same and you contributed the same $18,000 per year across your own employer and own contributions, the first portfolio with a 50-50 mix would have a future value of $2 million, whilst the balanced 70-30 portfolio would have over $2.7 million, which isn't too shabby. But by shifting to the more aggressive option, that value jumps even higher to $3.5 million. So shift your investment option from the default to the more aggressive option if you're willing to accept a little bit more volatility for higher expected returns. The fourth mistake was expecting steady profits. When I first started investing, based on all the research that I had done, everyone kept talking about how the stock market averages 8 to 10% per year. So naively, that's kind of what I expected my portfolio to do, to steadily increase year after year and to give me steady stock market returns of 9, 10, or 11% with maybe the occasional disruption. But in reality, the stock market is a roller coaster, except it's a roller coaster that that generally goes up over time, not down, but it does come with a lot of bumps along the way. In fact, the frequency of those bumps occurred more often than not. To put it into perspective, just how frequently market declines are, if we look at the last 30 years in the ASX, we have had market drawdowns by 5% or worse in all but one single year. So we can expect that 97% of the time, we'll see a drawdown sometime during the year of at least 5%. We've seen a drawdown of more than 10% or worse 21 times or 70% of the time, 15% or worse we've seen 10 times or 33% of the time, 20% or worse 4 times or 13% of the time, and 30% or worse 2 times or 7% of the time. Now within those same 30 years, even though there were so many market corrections and even some recessions, the market still averaged a return of 10% per year. In order to succeed at stock market investing, you should expect a wild ride, and you'll only get a good long-term return if you can stay calm as the market roller coaster goes up and down. The fifth mistake I've made was being afraid during market downturns. Now luckily I haven't made the mistake yet of selling any of my investments during a market downturn or recession, even though I will admit it was scary during those times. However, my mistake was that I was too afraid to deploy more of my capital into the market during those times. I stick to a dollar cost averaging strategy, so that means that each month I invest the same amount into my ETF portfolio. But during market downturns like the most recent one that we saw due to Trump's tariffs, it presented a great opportunity to invest more into the market at a significant discount. And whilst I did increase my monthly investment amount slightly, I could have invested a lot more had I not been so afraid. The stock market has this strange effect on our emotions. If the markets had gone up by 10% over the last few weeks instead of falling by 10%, most investors would probably have no problem investing their money in. The stock market is the only thing that the more expensive it gets, the more we want to buy it, and when the price comes down, we don't want anything to do with it. It's actually quite hilarious. Everybody thinks that the biggest challenge when it comes to investing is choosing what to invest into, but that's actually the easy part. The biggest challenge is actually managing your emotions and learning how to see past your own biases and not be impacted by all of the external noise out there in the market or news that is getting in your own way, resulting in you making bad decisions. If we actually look back at all of the global stock market corrections and recessions we've had over the last 50 years, after a 10% decline, on average, over the following year, markets were up 11.9%. After 3 years, they were up 43.5% and 70% after 5 years. After a 20% decline, markets were up 17.7% on average the next year, 24% over the next 3 years, and 50% over 5 years. And finally, after a 30% drop, up 6% over 1 year, 32% over 3 years, and 78% over 5 years. When the market goes up, it moves up quickly. So whenever you're scared to invest and your money is just on the sidelines, you risk missing out on some of the best days the market has to offer. The sixth mistake I made earlier on was not contributing more to my retirement, especially to my superannuation account. ASFA, which is the Association of Superannuation Funds of Australia, calculated that in order to have a comfortable retirement in Australia, you'd need to have roughly $690,000 as a couple and $595,000 for singles in your superannuation when you retire, which personally I actually think that number is much lower than what I would think is required in today's economy. There was a study done in the US that asked people how much they thought they needed to retire, with most people expecting they needed around $1.3 million in order to retire comfortably. Unfortunately, the median balance for males at retirement is only around $211,996, and for females, it's around $158,806. So combined, you're looking at around $370,000, which is still well below what ASFA recommends, and definitely what the survey found in the US. Furthermore, ASFA research has found that currently the great bulk of retirees totally exhaust their superannuation before they pass, which I guess backs up my point that people don't have enough saved away in their super to properly fund their retirement. Superannuation is the most tax efficient investment vehicle we have in Australia, and if you are investing for retirement and currently doing so through a brokerage account, it might be worthwhile considering whether it might be better for you from a tax perspective to be investing through your super. Back when I started working full time, I had already begun to invest in the stock market, but I was doing so outside of super. If I could do it all over again, I would still invest a portion of my money outside of super, but I would also allocate a portion to start salary sacrificing into my super account. The seventh mistake is getting attached to the purchasing price. Back when I started investing, I always hated investing when the price of an ETF or at a stock was at an all-time high. I always felt terrible because I knew that just a few weeks or months ago, that stock or ETF was trading at a much lower price. But here's a quote from Warren Buffett that I wanted to share.
The stock at 50, somebody's paid 100, they feel terrible. Somebody else paid 10, they feel wonderful. All these feelings. And it has no impact whatsoever.
What Warren Buffett is essentially saying is that we shouldn't feel differently about a particular stock or ETF because of the price that you purchased it at. The only thing that matters is how the company or ETF is likely to perform in the future. And if you believe it's going to continue to grow, then it doesn't really matter what your purchase price is. So the mistake to learn from is don't get attached to the purchasing price, even if it's at an all-time high. The last mistake is following the herd. Now, in many times in life, it often pays to listen to the crowd. If everyone raves about a particular restaurant, then it's going to probably be quite tasty. If a lot of people like a particular Netflix show, chances are you'll enjoy it too. Well, not so much when it comes to investing. In fact, if your friends are telling you to invest into this particular stock that they heard about, you should probably avoid it like the plague. If there's one situation where I think people are extra vulnerable to following the herd right off a cliff, it is when others, worst case their close friends, are getting rich doing something that looks easy. This was one of my biggest investing mistakes so far. A few years ago, it seemed like everyone was making money from crypto and altcoins. And even though I knew nothing about cryptocurrency, let alone these altcoins, I threw my hard-earned money at it nonetheless. More than I would like to admit, because my friends had made so much money and made it look so easy. And let's just say that nearly all of those altcoin investments, if you can even call them investments, probably more like gambling to be honest, was a very expensive mistake, and I hope that I will never make it again. Of course, hindsight is always 2020, which is why I'm making this video for you guys today. So those are the 8 investing mistakes that I've made personally, but perhaps you have another one up your sleeve. So let's all help each other out to avoid those, and feel free to share your experience down in the comments. If you found this video useful, then a like would be awesome, and subscribe if you want to see more content like this in the future. And another important thing to get right with your investments is getting your taxes right. So check out this video right here so you don't get in trouble with the ATO. And I'll hopefully see you in that video, if not a future video. And as always, thanks for watching.